Howdy, Jacob here. Today we're looking at the next company in our generic stock screener, ticker symbol ECVT in the metals and mining industry. Just under 800 million market cap, all pretty much double enterprise value, and growth is all over the place. Revenue is very sporadic. You have 170% year-over-year revenue growth as well as minus 56.6%. However, their margins are very consistent. So that was kind of surprising to me. Their gross margin is really anywhere between 24 and 30% of the last 10 years, with the operating margin between 10 and 17%. So, although their revenue's gone wild, their margins have not, which is very interesting. That must mean cost of goods sold is likely a commodity or a commodity like investment movement, whereas their sales, general, and admin are pretty flat. Because in most businesses, if your sales, general, and admin expense is your greatest expense, you're not really able to make less money and still have the same margins because you have to spend the same amount unless you were to fire off workers and everything, pay them less somehow. Um, so this must be heavy cost of goods sold, which we do see, but pretty consistent sales, general, and admin likely. We're going to look at the income statement after this. Return on invested capital, not great at all. The income statement does show majority of expenses from cost of goods sold, and they've actually decreased sales, general, and admin from 2017 to today. So that's helped with their margins. And although it's helped with their margins, with their revenues down quite a bit since then. Balance sheet has 88 million cash on hand with 9 million short-term debt, 859 million long-term debt. They have paid down debt very consistently since issuing a lot of debt for an acquisition likely in 2016. 2016, there's this other expense of 1.8 billion, and they funded it through debt. Outside of that, back in 2016, their capital allocation is mostly share repurchases and debt reduction. I think that's enough for me to make some assumptions here. So revenue growth side, probably not going to be looking at anything sexy. 3, their debt in relation to cash flow of 800 million in relation to cash flow of 100 million is over 8 years. So they do have a lot of debt. I'm going to be assuming 30 to 50% of capital allocation is going to debt reduction, which will have them have a very low PE due to the fact that their enterprise value will likely be a bit higher in market cap. And then for margins, I love that free cash flow is a bit higher. Maybe we'll be looking at 10 and 12% or so, with share change of, they do buy back a little bit of shares, but half of their earnings would be about 50 mil. So we'll see 30 mil does to them. Okay, so about $8 million would be 1%, and 2%, 16 million, 30 million if you include stock-based compensation, all those turning into shares. So let's try that, 2%. And we're saying the company's stock price needs to fall in half before you get the return we're looking for here. So this doesn't necessarily look like the sexiest business to me. I definitely would want this enterprise value and market cap to be similar. So they're going to have to focus on debt reduction. And again, when I look at this price, even if it were to screaming buy, it's not necessarily telling me I need to buy it because it doesn't necessarily take everything into consideration. It doesn't take the balance sheet and the management's future capital allocation into consideration. This is a mix of what they've done in the past with mine. And if they don't focus on debt reduction at all, and again, they have, but if they don't, they keep it at this 8 times. It's something I'm not attracted to, and I wouldn't get in it, whether it look like a screaming deal or not. Because the balance sheet is an incredibly important part of a business. And if you have so much debt compared to your earnings and free cash flow, that's a big concern. But right now, I'm just going to wait until it gets to a very cheap price, falling in half before I look at it more. Hope you enjoy the video.